Understanding market sentiment, where to invest in booms and recessions. Welcome to IBF, the channel where we simplify investing, business, and finance for everyone. Today we're diving into a topic every investor needs to master, understanding market sentiment and using it to guide your investments. Think of market sentiment as the overall mood of the market, the vibe, if you will. Are investors feeling optimistic and bullish, or are they pessimistic and bearish? That's what market sentiment tells us. So grab your notepad and pen, sit back, and let's get started. So why is understanding market sentiment so crucial? Imagine the economy is like a giant ship, and all of us investors are trying to figure out where this ship is headed. Market sentiment is like looking out at the sea and seeing which way the wind is blowing. It's about reading the signals, interpreting the data, and understanding the collective psychology of the market. If investors believe a recession is coming, they start selling off stocks, even if the economy hasn't technically dipped yet. By understanding market sentiment, you gain a crucial edge in navigating the turbulent waters of the financial markets. Alright, so how do we actually gauge this market sentiment? Luckily, there are some key economic indicators that can give us a pretty good idea of where the market is heading. First up, we've got GDP growth. A healthy GDP growth rate is usually a good sign for the markets. Then we've got employment rates. Low unemployment generally means people have more money to spend. Of course, we can't forget about inflation. If prices are rising too quickly, it can erode purchasing power. The ISM Manufacturing Index tells us how optimistic or pessimistic purchasing managers are about the future of the economy. And last but not least, we've got consumer confidence. If consumers are feeling good, they're more likely to spend. These indicators help us understand the market's mood and make informed investment decisions. Now, let's talk strategy. Let's say you're looking at those economic indicators and everything's coming up roses. GDP is strong, unemployment is low, consumer confidence is high, we're in a boom. So, where do you put your money? In a booming economy, the name of the game is growth. You want to be invested in sectors that benefit from increased consumer spending and economic expansion. Think about sectors like tech, consumer discretionary, luxury goods, travel, entertainment, and real estate. These areas tend to do well when the economy is firing on all cylinders. But remember, diversification is key. Spread your investments around and manage your risk. But what happens when the music stops and the economic party comes to an end? What do you do when a recession is looming? That's when you shift gears and move into defensive investments. These are the companies that provide essential goods and services that people need regardless of the economic climate. Think about utilities, consumer staples, and healthcare. These sectors tend to be less affected by economic downturns. During a recession, shifting your portfolio towards these defensive investments can help protect your capital and weather the storm. Now, we've talked about how everyday investors can use market sentiment to their advantage. But what about the big dogs, the professional investors? They take things a step further. Professional investors don't just buy stocks, they also short them. Shorting is betting against a stock or an entire market. It's risky, but when it pays off, it can pay off big time. They use their understanding of market sentiment to identify potential shorting opportunities. It's all about anticipating the market's next move and positioning themselves accordingly. Okay, so we've covered a lot of ground here, but how do you actually put all of this into practice? First things first, you need to stay informed. Keep an eye on those economic indicators we talked about earlier. There are plenty of resources out there like financial news websites and economic calendars. Once you have a sense of the overall market sentiment, you can start to adjust your portfolio accordingly. If things are looking rosy, increase your exposure to growth stocks. If a storm is brewing, shift towards defensive positions. ETFs can be a great tool for aligning your portfolio with market sentiment. And don't be afraid to seek professional advice. A financial advisor can help you develop a personalized investment strategy. Now, let's bring this all together with a real-world example. Remember the 2008 financial crisis? Leading up to the crisis, there were warning signs that the economy was heading for trouble. Housing prices were skyrocketing, subprime mortgages were being handed out like candy, and the financial system was becoming increasingly risky. Many investors ignored these warning signs and continued to pour money into the housing market. When the housing market collapsed, it triggered a domino effect throughout the entire financial system. Those who were paying attention to the warning signs and adjusted their portfolios accordingly were able to weather the storm much better. They moved into defensive positions, reduced their exposure to risk, and were well positioned to take advantage of the eventual market recovery. Look, understanding market sentiment isn't about predicting the future with 100% accuracy. It's about tilting the odds in your favor, making informed decisions and not getting caught off guard. It's like being a good sailor. You can't control the wind or the waves, but you can learn to read the weather patterns and navigate your ship safely. By understanding how market sentiment works, you can make more informed investment decisions and achieve your financial goals. Now, I want to hear from you. How do you use market sentiment to guide your investments? Let me know in the comments below. If you found this video helpful, give it a thumbs up, subscribe to IBF Business Channel for more investing insights, and share it with your friends. Until next time, happy investing. So, there you have it. Understanding market sentiment is like having an extra set of eyes in the financial markets. It allows you to anticipate potential risks and opportunities and make more informed investment decisions. By paying attention to economic indicators, diversifying your portfolio, and staying informed about market trends, you can position yourself for success. Remember, investing is a marathon, not a sprint. Stay disciplined, stay informed, and never stop learning. Thanks for joining me today, and I'll see you in the next video.